Imagine opening a crypto trading position, excited about potential gains, but then the market shifts suddenly. Do you know exactly how much the price can move against you before your entire position is automatically closed by the exchange? Understanding this critical point is not just good practice. It is essential for protecting your capital and managing risk. The leverage factor is absolutely crucial for liquidation risk because it directly amplifies both your potential profits and, more importantly, your potential losses. This factor dramatically influences your liquidation price, which is the specific market price at which your leveraged position will be forcibly closed by the exchange to prevent your balance from falling below zero. The core mechanism here is that when you use leverage, you are trading with borrowed capital, and the leverage factor represents the multiple of your own capital that you are controlling. A higher leverage factor means that a much smaller adverse price movement in the underlying asset is needed to erode your initial margin. For instance, using a 20 times leverage means a mere 5% price drop against your position can wipe out your initial margin. The exchange continuously monitors your margin balance against the current market price, and once your equity falls below a set maintenance margin requirement, the liquidation process is triggered. This rapid erosion of your margin due to amplified price movements is why the leverage factor is so central to determining how close you are to liquidation. To effectively manage this, you must understand your precise liquidation price before entering any leverage trade. Most reputable exchanges provide this information directly on the order entry screen or in your position details. You can also calculate it manually by considering your entry price, the amount of margin you have committed, and the specific leverage ratio you are using. Actively monitoring this price relative to the current market price allows you to anticipate and react to potential threats to your position. One insider detail to note is that some exchanges use an initial margin percentage in their calculations which directly reflects the inverse of your leverage. For example, a 50 times leverage implies a 2% initial margin requirement. This percentage is essentially how much of your own capital is required to open the position relative to its total notional value. Furthermore, factors like funding rates, trading fees, and partial liquidations can subtly shift your actual liquidation price, making continuous monitoring indispensable for sophisticated traders. Ultimately, recognizing the direct and amplified impact of the leverage factor on your liquidation price empowers you to make informed decisions. It helps you size your positions appropriately, set effective stop-loss orders, and avoid unnecessary capital loss, ensuring you can navigate the volatile crypto markets with greater confidence and control.